Good afternoon. Welcome to today's webinar, which is part of the M&A Advisors Distressed Investing series. During today's webinar, if you have a question, please submit them on the chat for the Q&A portion of our program. My name is Jack Butler, and I'm the Chief Executive Officer at Birch Lake Holdings, a Chicago-based merchant bank that blends decades of structuring and advisory experience with principal investing. It is my pleasure to moderate this roundtable on how to remove stress from distressed, or maybe better said, how to navigate the coronavirus pandemic through innovative M&A strategies by investing smartly and moving the economy forward. No one in this audience needs me to recite the litany of events and statistics that we're experiencing in real time. But for context, we are living in a somewhat disconnected, surreal world full of disinformation and inflammatory rhetoric. Nearly 90% of the non-essential workforce in this country is not working from the usual place of work. Most of our school-aged children are at home trying to learn virtually without the benefit of in-person teacher engagement and social interaction with their peers. Almost 200,000 Americans have died so far from the virus, with countless more still sick and to become sick. As a society, we've become almost numb to the weekly death statistics, which every week exceed the horrible events of 9/11. We're living in an economy of haves and have-nots, just not from an income disparity perspective, from an industry perspective. We've yet to properly understand and to assimilate and assess the damage to industries such as transportation, hospitality, and real estate, or to the devastation in urban centers. While industries like tech and logistics and the US stock market, underwritten by the Fed, at least at the moment, are flying high. What we thought when we started might be a couple of weeks home with our families has turned out to be a marathon. We're 6 months in, and it looks like this will continue well into 2021. Yet all of us in the audience live in a world where volatility, disruption, displacement, and uncertainty often yields opportunity. We invest capital in those opportunities that fuels growth in our economy. So what did we do here? For our part, I'm delighted that we've assembled a world-class faculty to discuss the trends that we're experiencing and to make a sense of what lies ahead and what we should be pursuing from an M&A perspective. So without further ado, I'd like to get to our faculty and have them introduce themselves, and we'll get moving forward. Duncan?
Thank you, Jack, and good afternoon to everybody. My pleasure to be with you all today. I'm a managing director at Winchurch Capital in Chicago. Before I joined Winchurch, I was a crisis and turnaround manager at Ernst & Young and J. Alex, or Alex Partners. Winchurch is a private equity middle market firm where we target companies undergoing change. And so we're an all-weather investor. We invest in all phases of the economic cycle, in distressed companies to turn around to growth. In distress, we invest through debt or equity. We're experienced as a stalking horse in an auction or acquiring debt, becoming a dip lender and credit bidding our debt, etc. But our aim is always to partner with company management and help make them businesses better. So thank you, and I look forward to our conversation today. Thank you.
Jay?
Thanks, Jack. And first of all, thank you to all the rest of our panelists. It's a pleasure to be here with you, and it's a pleasure to be speaking to this audience. Again, my name's Jay Goffman. I'm currently Vice Chairman of Global Advisory at Rothschild & Company, a large international investment bank. Prior to starting that position at the beginning of March, I'd spent 36 plus years as a restructuring attorney, most of the last 25 at Skadden, where for a number of years I did run the global restructuring practice. And in fact, Jack and I co-headed that practice for a number of years together. It's been a pleasure to work in this industry for many years, and I look forward to having a robust conversation today.
Thanks, Jay. Nick?
Sure. Hi, everyone. Nick Leone. I'm a partner at PJT Partners in the restructuring group, and I specialize in helping companies and creditors and shareholders and board of directors work through complicated restructurings. As you may or may not be familiar with PJT, PJT was spun out of the Blackstone Group around 5 years ago. And prior to that spin transaction, I was with the Blackstone Group for 20 years. And started my career in the late 80s at Drexel Burnham and later at Salomon Brothers in the early 1990s. Pleasure to be here.
And Steve.
Thank you, and it's a pleasure to be here. Again, I'm Steve Liff, and I lead Sun Capital's North American private equity efforts, and also sit on the investment and executive committees at Sun. I've been here for over 20 years. Prior to that, I was in leverage finance at Nations Bank and Bank of America. We focus on companies with untapped potential, whereby we can assist the management teams through operational excellence, because we have operators on our payroll with CEO, CFO, COO, and consulting backgrounds, and can leverage our transformational system toolkit. And we primarily focus on companies in business and consumer services, healthcare, along with companies in the industrial and consumer sectors. And given our operational bent, we can do anything from an underperformer, a good to great opportunity, a growth story, corporate carve out, as well as buying founder-owned businesses, again, using our operational side to maximize potential. And again, I look forward to the presentation today.
Thanks, Steve. Well, let's get started. I'd like to start with the elephant in the room by asking each of our faculty members to rate COVID-19's impact on the economy. And let's, for fun, reference the Saffir-Simpson hurricane wind scale of 1 to 5. Understanding that a Cat 5 storm is a catastrophic storm with structural damage and infrastructure failure. So I'm going to ask each of you, how do you rate this storm that we're in now, and why? Nick, let's start with you.
Sure, I'm going first. I would say a 4 out of 5. You know, when you look at the number of people that have lost their jobs, the number of people who are underemployed, the high percentage of Americans, frankly, that don't have adequate savings, and frankly, a lot of those jobs are not coming back. And so, again, when you look at how many thousands of Americans have been told by their employers in some of the industries, Jack, that you mentioned, you know, go home, we'll call you when we need you. I just think that that's devastating. And I think that what we're seeing right now, and I know we're going to get more into this, that there has been, you know, a lot of support from government agencies, et cetera, which at some point is going to dry up. And so I think, you know, when I look forward, just the devastating impact to a lot of Americans and a lot of industries that are going to be permanently impaired, this is a stating the obvious, just a huge crisis.
So, Steve, your son's home base is South Florida, so you're familiar with the scale. What would you, how would you rate this storm?
Well, Jack, that's an interesting question. And having lived in a hurricane zone for most of my life, I may have some thicker skin on this one. My thoughts are, assuming normal times are less than 1 with no storms, I think this is a category 2+ to 3. Coming our way with bands that have already hit, you know, many pockets of the strike zone. And I'll give you my reasoning, which is as follows. Many sectors have been severely impacted and will have some longer-term damage, which of course comes with some interesting opportunities for institutional and consumer capital, whether it be the restaurant space or brick and mortar non-food retail, for example. The bans have hit, and those folks have also had some tornadoes in the mix. You know, PPP loans and support of third-party lenders helped many of these folks weather the storm. But as we know, there are also many that are left with nothing. The industries that would disagree with my 2+ to 3 would, of course, include airlines and related maintenance, MRO type work, leisure, entertainment, auto parts, oil and gas, etc. And I would say for those that have avoided the Cat 4 and 5 type bans, the impact was tough yet ephemeral. Taking, for example, healthcare services, which is an area we invest in. Our portfolio in this arena had to hold their breath and hunker down after the initial storm, which lasted a few months with respect to severity. We are seeing anywhere from 90 to 100% rebound in collections as folks are heading back to the doctor. And there are also sectors that have massively benefited from this storm. For example, direct-to-consumer e-com, ditto on anything with respect to fixing up the home, as home goods and remodeling have been robust. You know, also think about, you know, industrial real estate, robotics, 5G, and the growth of bandwidth requirements, giving virtual meetings like this one, freezer and cool supply chain, and e-learning. But then there are those that are in the middle. And my reasoning for the 2+ to 3, noting that a category 2 hurricane is no fun, especially where I live, it's too early to tell what happens. And while this country is divided between the have and have-nots, lenders have kicked the can. The consumer, for the most part, is surviving now, and I'm sure we'll talk about that later. and the equity markets astonishingly have held up so far. Noting I'm not overly optimistic on the near to medium term public markets with the election coming and the other dynamics we have going on right now in the country, including the uncertainty that I'm sure we all feel at this point. So as such, I don't really see a V curve here, but again, a 2 and 3 category hurricane coming from my world is no fun.
Jay, how do you rate this?
Sure. Well, I would ask, is there a category above 5? I think we're in a category 5, but more of a Sally type storm where it's just we're just starting to see the pounding rains. I mean, think about it. This is the largest global economic shutdown since the Great Depression. Tens of millions of jobs have been lost. Many industries are just barely surviving. Anything to do with travel, the airlines, cruise lines, anything that gathers people together, they're just hanging on. And it's really just the first wave at this point. There's going to be a second wave, I think, coming next year. We've had many of the companies that otherwise should have restructured beforehand got pushed into restructuring in this first wave. But in the next wave, when people actually start to look at the balance sheets, there's going to be a second wave. And the only reason that we've been able to even stabilize this far has been the trillions of dollars of government support and Fed support and zero interest rates, which has helped stabilize things. But eventually, someday, we're going to have to pay for those trillions of dollars of investments, and that's going to cause another wave. So I think, I think the long-term implications here are significant. That being said, there will be winners and losers, and there will be opportunities if we can figure out who the winners are going to be. There's a lot of good investments to be made.
Duncan, you and I are Midwesterners. We don't have a lot of hurricanes showing up here in the Midwest that often, but how would you sort of think about this?
Well, I think I agree with all my colleagues here on the panel, and I think my only sort of picture comment that I'd add is we've been through some outer rain bands, and certain industries have been in the eye wall for some time. Oil and gas is a disaster. And I think, though, that what we have to look out for is the storm surge that's coming. And I think, second wave, third wave, I think there's going to be several waves of this as time marches on. Past recessions, we always had things coming to market pretty quick because they were damaged already. And then you sort of waited around for the better businesses to come available. And I think that's going to happen again to us. Again, certainly businesses that have been through or filed early on here were ones that are already in trouble before COVID started.
Well, according to the most recent bankruptcy statistics for the first 2/3 of 2020 through August, business bankruptcy cases are up almost 30%, with mega cases up at a substantially higher rate. Nick, have we seen the peak yet? Do you have a view of what lies ahead on the horizon?
So my own personal view is I don't think we've seen a peak yet. A lot of companies who have been struggling as a result of COVID have at the same time raised quite a bit of capital to create as long of a runway, financial runway, and liquidity runway as possible. So I think that has supported a lot of companies that would otherwise have to contemplate filing Chapter 11. The other thing, and I mentioned this a few minutes ago, and others did as well, that in addition to a lot of companies raising capital on their own, both companies and consumers have benefited from a lot of government support. At some point, just by definition, that has to end. And then the other thing I would say, and I said this a few minutes ago as well, is I think that there's a very large risk of just sort of permanent changes to how consumers spend money, frankly, just because of the devastating impact that they've had to their own personal finances. So I think when you combine all of that, I can't tell you when. I don't know that it's 2021 or later this year or what. But my own personal view is we haven't seen a peak. We haven't seen the peak in this business yet.
So, Steve, I want to ask you a related question, which I find kind of a conundrum. And I know you and I both look at trends in the economy and try and sort out what makes what. So while business bankruptcy cases are up by 30%, consumer bankruptcies have declined by 27% from last year. and have declined at a much higher rate in the last few months. Do you have any insight about what this means? Is it good news or bad? Do you have any insights about consumer intent or behavior in the pandemic? Because the results are exactly the opposite of what I would have expected to see.
Yeah, that's a great question as well. And I go back to, a lot of the comments that have been said about, what category storm we're in. And I echo in this response a lot of what Jay mentioned, which is there's a lot to come. So consumer bankruptcies, yes, they are down, but unemployment claims are at all-time highs. Noting unemployment checks allow people to, pay their monthly bills without having to file, and that's a big reason bankruptcies are down. Furthermore, many homeowners and renters are not being penalized for missing payments right now, given some of the pandemic laws that are put into place. And the same thing is happening on consumer debt, as many states have companies from enforcing collections at this time. Again, I see this as a Band-Aid for many, and the wound will for sure reopen. So my thought is people are kicking the can on payments as they can right now, keeping their savings, including stimulus checks, and some are hanging on given the fact that the markets have been robust and their 401k balances have rebounded, at the trough of the market during the height of the pandemic and lockdowns. So given these factors, I think bankruptcies will spike at some point. These government protections are temporary, and those that owe money and can't pay now will owe more and more as time ticks on. So I think the rat has not gone through the snake yet. So for the consumer, again, I think there's going to be a have and have-nots mentality here, and I do think it's going to be problematic. And again, I go back to what all of us as panelists have mentioned already, that there's a lot more storm to come, and the consumer, those that are debt-ridden, are really going to face some hard times, and I don't think that's going to be good for the overall economy at all. So I expect consumer bankruptcies to really spike.
Let's take a look at the federal stimulus. The trillions of dollars of federal stimulus spent to date can be divided into 4 buckets: direct to consumer, sort of unemployment benefit enhancements and stimulus checks; direct to small businesses, the payroll protection program and small business loans; targeted grants to specific groups like airlines, state and local government, PPE related money; and the Federal Reserve, enhanced emergency relief and authority and money given to it by Congress, the Main Street Loan Program, the Corporate Bond Repurchase Program. And that doesn't even include central bank monetary policy like central zero rates to 2023, or Treasury actions not to criticize loans in 2020, or the governor of New York changing the state banking laws on an emergency basis, saying it's an unsound banking practice to not give forbearance agreements out. So Duncan, how is all this federal action to date, and that which is yet to come, blunted the impact of COVID? And has it changed the curve of bankruptcy filings? Is there a second wave that's being deferred to? What do you see on the horizon?
Well, I think Steve just said it, and I think we've said it a little bit before in our talking about the hurricane and the imagery of that. Certainly the Fed and federal action, Congress, et cetera, has blunted this. Businesses were facing imminent shutdown when the CARES Act was passed back in April. And I think that the way that it was rolled out was sort of messy, but it got cash on the street really fast. And so I think that there's been a lot of staving off of what was going to happen, dramatic effects, for example, in restaurants and other businesses where, they could go and get a PPP loan and then burn the money, but they don't actually have to apply for forgiveness until later. And so I think it's going to be interesting to see how many companies actually get full forgiveness of these loans and what effect that's going to have on their balance sheet. I'm certain that they've spent it on a lot of them on non-payroll related items. So I think certainly there's been a big liquidity push. I mean, PPP alone was $659 billion into the economy. 130 was not used, amazingly enough, but over $500 million directly into companies. So payroll support also to various industries. the mention before of able to get your mortgage deferred for, 2, 3, 6 months without any issue. The CARES Act relaxing the definition on what a troubled debt restructuring is has really changed, I think, the game temporarily. So I think that there is going to be a second wave as people sort of run out of these options of having to take action. For now, people can ignore reasonably, but they can ignore now because they've been given a lot of support. So I think definitely there's going to be more to come.
Jay, you talked a few minutes ago about winners and losers, but there are clear winners and losers in this pandemic. There seems to be a disconnect between capital and liquidity and that overhang versus the reality of the underlying performance of the economy. I just wonder, what have been the biggest surprises from your perspective, from an economic standpoint, so far in the pandemic?
Yeah, no, it's an interesting question. I think for me, the biggest surprise was the speed with which the Federal Reserve and the U.S. government got together to inject trillions and trillions of dollars into the economy to bring interest rates all the way down to zero to try to stabilize things. I think that was a lesson that people learned from 2008, 2009, how important that was. And it did stabilize things. It allowed industries like travel, like cruise lines, like aviation, like hospitality to survive, not prosper, not do well, but survive. And so that was a positive surprise. Now, the flip side, the other thing that it caused, however, was by putting all this money into the market and bringing interest rates down, it brought a lot of liquidity back into the stock market. So the stock market bounced back in a rapid V-shaped curve, which I think makes people feel, or a lot of people feel, like we're doing okay and coming out of it. If you take a step back, though, and you take a look at the real world economy, I think you get a completely different picture of where things are. I think other big surprises are the way the money is poured into the tech companies, the Teslas, the Apples, the Amazons, the Facebooks, to drive up their numbers in ways that I don't think any of us could have appreciated. And then the biggest change, I actually think, the biggest surprise is how well people have generally adapted to this crisis. People have gotten used to working from home. People have gotten used to Zoom calls. People have gotten used to working in ways where they have their families around. And I think those types of changes, and I think we'll get to that later, but I think those types of changes, it's changing the way we live our lives and the way we work and the way the world will evolve over the next several years. And that will have significant implications for the worldwide economy.
I'm one of the 10% of people who are actually traveling, right? I'm getting on airplanes.
You've always been a crazy guy, Jack.
And I will tell you, I honestly don't believe that I think we're almost numb in the sense that we're not really assimilating what's going on. I was in Midtown Manhattan yesterday, right? For meetings where you can only have outdoor meetings because there's no place to eat indoors. And, you walk in mid-Manhattan and, a third of the buildings are shuttered up. They're boarded up. The number of people, it's 10% of what you'd normally expect to see. Right. And, there are places that are just gone. Right. It's hard to believe that they're kind of coming back. I walked through O'Hare last night, literally, when I walked through baggage claim, the whole baggage claim hall, there were 2 other people in the baggage claim hall. Right. I mean, it's almost, and 90% of the, you go through LaGuardia's magnificent new airport that they built. Right. And 80 to 85% of the concessions are closed. Right. Because, they're not operating, and so I mean, and I'm just doing my thing and going through normal business things, but I don't know, have we really assimilated, guys, what's actually going on? Do we have a handle on what's going on, Duncan?
I'm not sure we do, but one thing I am thankful for is that I don't have to walk through LaGuardia during the reconstruction, during the shutdown. That was one bonus of being that.
You have your own private terminal.
I feel that as well, Duncan.
Yeah. So look, I think there's a lag here because there's been so much liquidity pushed into the marketplace, and I think that also the COVID came on and businesses started to fail but it wasn't any fault of their own. So I think everybody's been given a big pass for now, except for those businesses that everybody was fatigued with at the outset of COVID. They were already in trouble. But I think that we're going to go through a number of phases here as people, what happens in these situations is that people have to get fatigued, and you have to sort of run out the process. And, if there's a private equity investor involved, for example, when does that investor lose faith and withdraw its support of supporting the company? So I think that over time, I think we're going to see, more situations come to light that are investable. And I think it's going to be several lags before we get there. I mean, we saw it back in 08, 09. We saw how it took sometimes several years for businesses to come to market, but they were damaged at the outset by the recession.
So, Nick, how are companies, sponsors, other investors, and creditors approaching restructurings during the pandemic versus 2008 or prior economic turndowns? Has the opportunity set widened? Are you seeing better risk reward in these opportunities? If you, give the adage, never let a good crisis go to waste. How are companies and investors taking advantage of the current environment to either gain market share or trim costs?
So Jack, let me start with the first piece of that question, which is what I've seen over the last 6 months. And again, we've been dealing with COVID for since March, so we don't have tons and tons of experience in terms of how companies and creditors are dealing with this. But what I've seen sponsors, how I've seen sponsors and creditors specifically react is for so many institutional investors, including lenders, they have so many crises, so many fire drills that they need to deal with, that if there's a company that is, I'll use the word struggling, or significantly impacted as a result of COVID and the impact of their business, if they don't have to do anything now, they would rather not do something now. Because again, I'm not a professional investor, but my sense is from sponsors and creditors, they have enough fire drills that they need to devote attention to, that if there's something that, they can, sort of do a light touch restructuring, whatever that means, if they can do that, that's the strong preference. And in terms of the other thing I would say, in terms of what I've seen, how I've seen sponsors react over the last 6 months, in addition to preferring to just sort of kick the can down the road, it feels to me like sponsors are very cautious with capital. In terms of, obviously, this could be a great opportunity for sponsors or other investors to put capital to work. On the other hand, none of us know where this is going to bottom out. So that's Jack. That's how I'd react to the question.
So Jay, I want you to answer the same question, and I want to go to Steve and Duncan and ask them a related question. So, what's your take on it, Jay?
It's a funny place where we are right now, Jack. I think I break the companies down into different categories. There are those companies that really should have restructured over the last several years, but we're continuing to push the can down the road and just biding time. And a lot of those companies, when COVID hit, that was the time when they had to do their restructuring. They either ran out of liquidity or they used it as their excuse to do the restructuring, or their lenders said, well, this is the right time. Let's just get it done. So you have those types of companies. But then I think you have a whole different set of companies that were doing just fine before the crisis. And then all of a sudden, they're hit by this massive problem. And in a lot of those cases, the lenders look at it and say, no, this is a good, solid business in an industry that's been hit hard. We're going to give them more time. We're going to push this out their liquidity out a year or two. We're going to waive a whole bunch of covenants because we think long term this is a business that will do well and repay us. So I think you break those types of companies into a couple categories. But again, I think this is really just the first wave. As we've all said, there will be a very significant wave coming in the future. And you're going to see a lot of companies need to restructure. And the key, I think, for anyone investing, look, we all have to figure out what the right assumptions are. Where's the world going? Which industries are going to do well? Which industries, whether it's logistics like Amazon, whether it's high tech, whether it's artificial intelligence, are going to do well in the next phase as the world has changed, because people's living habits have changed. And if we can figure out if anyone could figure out sort of, how people are going to change the way they live, they'll be able to figure out the next wave, and they'll figure out where they want to invest their money and where they want to keep it out of.
So Stephen, Duncan, I'll share one final weather analogy, and then I'll stop with the weather analogies. But this sort of feels like a tsunami to me, right? And for people who study tsunamis, the water recedes first, right? And then that wave comes. And I just have this feeling as I walk around the country in different cities, and I sit with investors, and I look at opportunities, and I sit with companies. 2/3 of which you do virtually, but a few things you do in person, and try and kick the tires. That we're in the water receding period, and we're trying to figure it out. And you both have portfolios. You have portfolio companies. You have capital calls. You have people who you're looking, just as Jay said. There's a lot of good companies out there that are having at least intermediate problems, right? And so I just want to ask you a simple question, and we'll go back and ask some other questions in a minute. But a simple question, and start with you, Duncan, or Steve. Start with you, and then go to Duncan to you. How do you decide where to put more money in right now? When you're looking around, where are you doubling down, and where are you saying, "Sorry, not me, I'm done"?
Yeah, well, Jack, it's an interesting question, and I agree with Jay and what he was talking about. And Nick, in the sense that the stressed opportunities are not yet in full force. But similar to my consumer answers on bankruptcies, I believe that wave is coming. I mean, stimulus and lenders have helped these companies tremendously, and we hear that our restructuring advisors, like Nick, are getting very busy. Of course, is a leading indicator of what's to come, which is intriguing to folks like us that can focus on turnaround and underperformers. But what we're seeing today are either very, very good assets or those that have fared okay, noting that there's high uncertainty around the prospects, given the environment here. The problem that we have is when we see a really good asset that hasn't been as impacted by COVID and/or that can benefit from COVID with the assumptions on changes of patterns, whether it's work from home or consumer. The auctions are just so robust. And the problem that we have in private equity, and I'm sure Duncan would agree, is private equity firms have a window to put their money to work, as we all know, and the pandemic has caused a lot of strife. But it's really exacerbated the amount of money on the sidelines, because that money hasn't dried up the pandemic. It's still there. These funds, and the world went quiet for a period of time. So, we're still in a low interest rate environment, and for the most part, the leverage market is accessible and in business. So, where we're active, where we're spending time are on some of the direct consumer opportunities, noting we do have to normalize any spikes due to the pandemic, and also noting that this may further spur a longer-term effect on consumer buying patterns, which is something that Jay mentioned, whether it's delivery, etc. Healthcare has also been active, and while it's recession-resistant, it's surely not pandemic-resistant. But longer term, absent some of the higher risk reimbursement sectors, this is a sector that continues to be in favor and can benefit from our operational expertise and institutional capital. We've seen some of that in events, noting that we have an election coming and that needs to be taken into consideration. But business and consumer services have also held up well, and we're quite active in that right now. I would also say that we have been looking at a lot of corporate carve-outs as larger conglomerates are trying to be very focused, and we can pick up some corporate orphans that have good market share yet have been ignored. And similar with respect to founder-owned businesses, as the pandemic has caused many to consider taking chips off the table while still remaining, at a solid minority piece. And those that have solid businesses can benefit from firms like ours, not just institutional capital, but also with operating expertise, where these founders can take advantage of competitors that are not faring as well, meaning they have the opportunity to really gain market share. And as far as widening or narrowing, I think M&A is picking up quickly, but the solid opportunities are like magnets and attracting, a vast number of institutional capital players hungry for deals. And I'm still amazed, truly amazed at the multiples we're seeing in the market now. And we have to be cognizant of this as we think about multiple degradation on the back end when we're buying something that's either doing very well and or benefiting from this pandemic.
So Duncan, how do you decide the winners and losers, the people you're going to support and the companies you're going to step away from, or the industries you're going to not look at for the time being? How are you making those calls at Winchurch?
Well, I don't think that we're not really working differently than we did before the pandemic. We've always been pretty careful at the businesses that we invest in. I mean, our track record shows that. I mean, we're in our 5th fund now, and we've been a top quartile performer at least for 3 of them. And so that's we've had a pretty good run track record wise. I think, the issue is that, there's a lot of capital that's looking to be deployed. And so, there's undamaged regular way businesses coming to market. It's very competitive. Prices that held up during the lockdowns are going for premium valuations. I mean, even higher, I think, than pre-pandemic. The have-nots aren't really coming to market unless they really, really need to. And that means, in a sense, that they've got some other impetus, like a restructuring underway or something like that, that's causing them to come to market. So we are looking at some carve-outs. Carve-outs have been great for us over the years. Certainly, businesses are looking to redeploy capital, so it's an ideal opportunity now for that, and that marketplace is also pretty competitive. So we've also been focused on add-ons to our existing portfolio. We're sticking with the industrial segments that we always have. We've always been opportunistic. We're very careful about add backs or pro forma adjustments. Not just the COVID related add back, but it's also these businesses like a grocery chain that's had unprecedented growth in sales in the last number of months, and is that going to last? And we're being very careful about that, because the hardest part is determining where the consumer is going to go, and those end markets that affect our industrial companies that we usually invest in. How is that going to affect the businesses that we're typically an investor in? And that's the guesswork that's hard to get to. But I think you got to diligence it, and you got to talk to as many people as possible to enable you to form a conviction about whether or not that's a good investment to be involved in.
Yeah, I think Duncan hits on a great spot as we both obviously focus a lot in some overlapping areas, but those add-ons have really been a good driver during the pandemic, where some of our companies can take advantage of perhaps weaker players and gain market share. So that was a great point, Duncan.
So Jay, I'm going to ask you a question about the difference between what's going on and the wide gaps between what we see in the stock market almost every day, maybe not every day, but almost every day, and kind of the fundamental economy. Imagine the implications about that, but I also want to throw in an election twist, and we're not going to turn into a political panel and try and predict what's going to happen in November. But I am interested from all of you, so I'm going to go around the table and ask everybody. I am interested in how you think where we are at the moment, not just with the pandemic, but with the political environment in the country, and with a presidential election in a month or so, how investors are paying attention to that, if at all, and how that's being sort of factored into the mix here. So Jay, let me start with you, and then we'll go all the way around the round table.
Sure. So let me start first with the dichotomy between the stock market and the real economy. And I actually do think they're 2 completely different worlds. What's happening in the stock market is completely separate from what's happening in the fundamental economy. The stock market is being driven, in my view, solely by 2 things. It's by the fact that the Fed's brought interest rates basically down to 0. And so investors are chasing yield, and they can't get yield in the bond market, so they're chasing in the stock market. And secondly, it's the amount of liquidity that you have out there. And I recently read that the the money supply in the U.S. has increased by 40% since the beginning of the year. It's a remarkable number. That's never happened before. With all that additional liquidity, it's got to go somewhere, and a lot of it's going directly into the stock market, mainly into a lot of the tech companies. The fundamental economy, we've talked about it. You know, entire industries basically shut down, tens of millions of dollars, tens of millions of jobs lost. You know, industries, whether it's, you know, hotels, you know, retail, anything to do with congregating, restaurants, they're all shut down, and many of these companies will never come back. So I think it's completely separate for now. I think at some point the two will coincide again. I think at some point interest rates will have to go up, not for a while, because the Fed said that. And at some point, we're going to have to pay back these trillions of dollars of money that we borrowed. And when that happens, then I think the real economy and the stock market will bounce back. I read just yesterday that Blackstone was suggesting that the stock market over the next 10 years is not going to be a great place. And to me, that makes a lot of sense, because eventually we're going to have to pay for these. So I'm sorry, Jack, what was your other question?
Well, before I turn to Duncan, I wanted to ask you the other piece of it is this election overhang, this presidential election overhang, affecting M&A activity, deal making as we go into the end of the year, or is it just on the sideline?
Personally, I think people have become insensitized in a way to the federal election. We're so polarized in this country, and this is a very important election coming up. But I think it adds a certain amount of uncertainty. So when people think about, I would guess if you're a private equity investor and you're thinking about investing more money into it, you'd sort of like to know who's going to be running the country going forward and what their policies are. But I actually think it's more of the pandemic and the other factors that are driving the economic decisions than the political ones right now.
And as I turn to Duncan, it's and ask the same questions. You know, what I've heard some people talking about, but I think we're running out of the game clock for this, is, you know, without picking sides or picking a point or a result, the concern is that if the Democrats win the Triple Crown, right, and take over the Senate and the House and the White House, that there'll be a fundamental change in tax policy, and that people are sort of saying, "Gee, do I need to get something done this year?" because I can't, you know, I better not do it in the first quarter next year, because I'll be paying, you know, a different capital gains rate. There'll be different taxes applied to ordinary income and so forth. So I think that's at least I've heard that conversation. In fact, I've been involved in that conversation. So Duncan, again, the two questions is disparity between the stock market and the fundamentals of the economy, and is there an election overhang that's playing, you know, anywhere in the thinking of private equity as you think about it?
Well, I'll do the private equity overhang and the idea that tax policy is going to change materially under Biden versus Trump. I think that before, when there was a change in tax policy, we saw this several years ago, and the cap gains tax went up. It drove a buku amount of deals to market. But these were all, again, businesses that were healthy. They could command a pretty good value. There was no reason for them to sell other than let's sell now because of this tax-related incentive for us to sell now. If you're a distressed business, not well-performing business, there's no reason to sell for tax reasons. You're better off fixing your business and coming to market later on and enduring whatever tax effect you have to endure at that point. So, but I have heard of deals being prepped for market with the idea that if there is a change in the presidency, that they would become to market pretty quickly. So I've heard that's taking place.
Nick, I'm sorry.
Go ahead. No, go ahead.
Nick, what were your thoughts?
So I would say two things. I agree with what Jay said and what Duncan just said. Two things that haven't been said yet. I think investors over the last decade have done pretty well buying into the dips of stock markets, stock market dips. And as a result of that, I think what we've seen over the last decade, if not longer, is that when the stock market dips, the compression between dip and then recovery keeps getting, tighter and tighter and tighter. So I think that's part of it. And then the other thing I would say, which I would say is one of the important lessons for professional investors, since 2008, 2009, is don't bet against the Fed. So when the Fed, says that they're going to support the economy with monetary policy, by bond buybacks, et cetera, keeping interest rates very, very low, people have seen that movie before, and it generally, supports the stock market. So I think I agree with what everyone's saying in terms of the fundamental disconnect between where the economy is and where the markets are. But I think, in agreeing with what Jay and Duncan said, those are two other points that I would add to why I think the market's doing quite well.
Steve, your thoughts?
Without regurgitating, a lot of what's been said, I wholeheartedly agree with Jay, Duncan, and Nick here. And, I do think there is a lot of what I call irrational exuberance in the public markets. And it's being fueled by exactly what my three panelists counterparts have said. And I do believe that there is a lot of activity going on right now to get deals done before year end for those that are doing quite well. And I agree that some of this stress will creep into next year. And also, finally, what I would say is, from the deal side, especially on private equity, we are having to think about what this election means, and we are taking that into consideration, as we think about how to build out our returns and overall modeling efforts, with higher taxes that obviously impacts cash flow, and especially in an environment where interest rates are low and leverage is still available. So, we are taking a lot of this stuff into consideration, not just with respect to, multiple buy-ins because it's heated and hyped right now, but also with respect to, some of the nuances that could come with the changing of the guard in the White House. And even if there's not, at some point, a lot of this stuff has to be repaid, as Jay mentioned. So I agree with pretty much all of what the panelists have said.
Let's talk about innovation for a few minutes. We've talked about elements of it already about this webinar, but Jay, I want to ask you, and then I'll ask Nick, how is the advisory world pivoted, if at all, to the challenges and limitations imposed by the pandemic and to the opportunities that are presented today?
Again, very, very interesting question. I actually think from an advisory perspective, as well as from an investing perspective, this is a very unique time period. The lifestyle patterns that everyone has gotten used to for the last 50, 60, 70 years, they're changing. And that's going to have a fundamental change in the way businesses and industries evolve. So I think from an advisor perspective, we have a unique opportunity. For years, we've all been trying to help our companies and decide how to do their transactions, how to do their restructurings. I think we're at a moment now where, rather than if we're really adding value, we're not talking about how we do things. It's about what should we do. What does the future look like? And if we can help our clients make the right assumptions as to what the world will look like over the next 5 to 10 years, then figuring out how to get that done will be easy. But to me, you still have some people throwing money at situations because there's a lot of liquidity. You have other people being cautious, but I don't think people have, as you said, Jack, I don't think people have figured out the fundamental shifts that are going on yet, and what the implications are. And to me, that's the fun stuff, is trying to take a more macro view and add value in that way.
So Nick, how do you think the advisor world's pivoted? What kind of innovation is going on from your perspective?
I don't know that I would call it innovation, but I guess one observation that I would make is that for during my whole career, which again has been a few decades, my focus has been, and I think the advisory focus in restructuring has been, 95% on the balance sheet, making sure the company has adequate liquidity, making sure that they're not over levered, and sort of leaving what's happening with the business and what's happening with the operation toward the management team and the board. I would say that given what we're all dealing with, and whether it's professional advisors, investors, or people that actually run real companies, no one knows where this is going. No one knows how long this is going to last, the vaccine, how that's going to work. So I think that what I've seen over the last 6 months is that as an advisor who typically just focuses on balance sheet liquidity, capital structure, we're getting more and more involved in the boardroom and the management teams thinking about the business itself, because they're not experts in COVID. They're not experts on when this is going to turn around and the shape of the turnaround. And obviously neither are we. And so we're trying to figure this out together. So I don't know that I would call it innovation. It's not. But that's a change that I've seen over the last 6 months.
So Duncan and Steve, a minute from each of you, if you would, please, on how have you guided and assisted your portfolio companies during the pandemic, and what is there innovation going on both at the company level and from your own perspective on how you're moving forward? Duncan, you first.
Well, it's hard to say that innovation has taken place. I would say that like the rest of sort of the economy, what we were thinking about doing anyway, it's like we took action faster. So, when COVID first started, we probably 2/3 of our portfolio was shut down, not operating. And so, initially it was about liquidity, shoring up the balance sheet, et cetera. And then also dealing with a couple of problem situations in our portfolio that were getting wiped out. Thankfully, all that stuff has worked out as the Fed came to the rescue, and Steve Mnuchin thought up, or whoever thought up PPP or whatever. Things got a lot better fast. But what we've done is we've taken advantage of plans that we already sort of had in place for the year or even for next year, and we've been implementing those much more quickly. So when the full economy does come back, we're going to have much leaner organizations than we had. We will have implemented software, upgrades, et cetera, that we're on a much faster track than we had before. So our businesses are much better prepared. And one thing that we've done especially is to make sure they're a digital strategy. Let's say, for example, in connection with marketing, that we're much more equipped to that, because obviously with people staying at home, there's no pressing the flesh of sales guys going around to different industrial locations trying to sell parts. They're having to do it over the phone or over Zoom calls. So I think that we've seen a lot of innovation in our sales forces that way.
Steve?
Yeah, it's similar to Duncan. We started off, very quickly and got on top of our portfolio companies right out of the gate. While we always, monitor cash flow and liquidity, we created, new cash flow templates and forecasting tools for our companies to follow. We continually followed peak and trough cash needs, and we were always up to speed. We had weekly cash calls, literally went line by line on items and worked with our management teams to figure out where we needed to cut, where we can't cut, but also, as importantly, where should we invest and take some risk, where we can pick up market share. And then we worked with our, teams to figure out, as time went on, and a lot of these costs were taken out, and this is something that Duncan mentioned, where do we need to bring it back, and where do we not need to bring it back, and how can we be leaner going forward? And of course, we work with our lenders to ensure liquidity was robust. We tapped credit lines. We're very successful in that. Our lenders were supportive. We aggregated literally all of our cash flow and other reporting stats, especially for this environment, and had many of our companies chat with each other and discuss best practices. What was working, what wasn't. How do they deal with HR issues? How are they dealing with safety issues? It's amazing how much that has paid off. We're big believers in sharing winning strategies and learning from our mistakes, and of course, continuous improvement. For the most part, our portfolio is in very good shape, especially as the last several years we've focused on, recession-resistant businesses, given the length of the pre-pandemic bull market. So, a lot of overlap in what we kind of have done and what I heard from Duncan.
Thanks, Steve. Well, gentlemen, it's time for closing statements, or maybe closing arguments. And that is, I want to start with Jay and ask each of you a minute or two from each of you on using your crystal ball. What do you think will be the biggest economic changes you expect to see in the short and intermediate terms? Is it the right time to invest? And what are some of the risks and challenges that keep you up at night? Jay?
Well, that's a very good question, Jack. I have to get on my crystal ball and clean it off a little so that we can try to figure it out. But, look, again, we've talked a lot about sort of the way people's lives have changed. And let's just sort of break it down. Commercial real estate. You start with the fact that we're all working from home. We've gotten used to working from home. There's Zoom calls. There's less people going to the office. I think one of the end results is that a lot of companies are going to figure out that they don't need as much commercial real estate space. If that's right, then it's going to affect not only commercial real estate, it's going to affect residential real estate. All of a sudden, yeah, some people want to live in cities, in big cities like New York and Chicago and elsewhere because they like it. They like the theater and everything else. But a lot of people live there because they didn't want to commute. All of a sudden, if they don't have to commute, then there's going to be a real impact on residential real estate. You know, that in turn will affect the number of restaurants. It will affect clothing stores. Take a look at all of us. We're all dressed up out of our sweatpants for the first time, wearing, you know, jackets and shirts, and you know, but how many of us have had to go out and buy new clothes? We don't, because it's the world's changing, the patterns are changing. So I think that sort of, we have to take those into account. On the positive side, there's always winners and losers, as we've said. There's, for every person moving out of the city, there's more money being spent on residential real estate. You're starting to see more satellite offices popping up in the suburbs as people figure out you don't have to drive into the city all the time. More money is being spent on tech, Zoom, and things like that, as opposed to airlines. So, is it a tough time to invest? Absolutely, because there's so much uncertainty. People aren't sure about what the right assumptions are going forward, and you need to know those assumptions, or at least have an idea to make money. But if you can come to a conclusion as to what the right assumptions are, the opportunities for making money, I think people are going to look back and find that they're limitless. There's going to be entire new industries evolving. You know, think about it. If you could have bought into Amazon a year ago, before the crisis came, and now everybody, how many of us get not even daily deliveries from Amazon, but hourly deliveries from Amazon? So I think there are winners and losers. I think it's hard to make those assumptions. It's hard to have the courage to invest. But if you do and you make the right decisions, I think you can make an unlimited amount of money.
So, Jay, I'm not going to embarrass the panel by making you all stand up and seeing your sweatpants you're on right now.
You don't want to see my bathing suit?
But and I will say to the audience, as we can finish these closing statements and arguments here, to keep your questions up in chat so we can take them during the question and answer segment as we go forward. Duncan, your closing observation.
Well, I think there's been a lot of dislocation in the economy, and I second the sentiments that we just heard, that you got to have courage and conviction about the investment that you're going to make if you're investing at this time. I think it is a great time. It should be a great time. I think that being said, there's a lot of competition for quality investments, and I think that a lot of the issues that we're talking about here show up in valuation. And so that's I think something which then obviously means that great opportunities to invest and reap rewards later on down the road when the economy is fully back. You know, one thing that I think is going to change more too is that, you know, before even COVID, our supply chains were affected significantly by tariffs, and I think that COVID has exacerbated that. And so, for me, as an industrial manufacturing sort of sector investor, I'm eager to see more investment back, at least in North America. Certainly, it's been going to other countries besides China, and I think we've seen that trend already started. But I think we're going to be seeing more of that because, boy, you know, just-in-time, logistics supply chains were cut off really quickly, and I think people were surprised by how quickly that got shut off. So I think I see some opportunities in that sector. But I think it's a great time to invest.
Nick, your closing observations.
I don't know if it's a good time to invest or not. I'm not a professional investor, which is probably good for my family. But an observation that I would make is this: is that if you look at how much corporate America has changed in the last 10 years, you know, if you went back to 2010, so much of the impact of technology and how it affected much of corporate America. And, you know, if you think about, again, maybe 15 years ago, there were probably more Blockbuster videos in Manhattan than Starbucks. And technology put that company out of business. I think if we look forward over the next 10 years, the largest impact to corporate America is going to be changes to consumer behavior. Look, there at some point there's going to be a vaccine. People are going to go back to work, but are people going to go to sporting events to the extent that they did before? Are they going to go to theater? Are they going to go to a theater? Are they going to get go on a cruise ship? You know, the 5 people on the string. You know, we spent our whole careers jumping on planes in an hour's notice with 5 of our colleagues to fly to Atlanta or fly to Detroit for a 1-hour meeting. Does that ever come back? Maybe some of it does, but I don't think it comes back to kind of pre-COVID levels. Not because, you know, we're afraid of getting sick. Again, I'm saying, you know, once there's a vaccine, but it's because we've gotten so used to this. So I think that, and I don't know how to measure this, but I think the biggest impact going forward is going to be how consumers change their lives.
Steve, your closing observations. You get the last word here.
Right, and it's hard to argue with what all the panelists have said. The biggest challenges I see will be consumer spending, as I do believe more personal bankruptcies will come, along with a shaky public market, which could impact consumer enthusiasm, which is equally as important. And I think if we are faced with higher personal income taxes, that could take a toll on business reinvestment and hiring. I do think there are areas Jay mentioned that will be robust. For example, infrastructure spend should be fine and will offset some of these hurdles. But I do think there will be slower than expected job recovery for employees. So net, I see a very shaky few years to come with perhaps many peaks and valleys and very little stability on the floor under our feet. But similar to Duncan's point, we're professional investors, and where there's losers, also winners arise and shine. And we as professional investors need to stick to our knitting, buy the companies that have that great market share, that have that great service, that have that great product. And how can we step on the gas and really take share and, take advantage of a difficult time. And I think in times like these, there's opportunity to make a lot of money and really create some of these businesses that are small and growing, especially pre-pandemic, to be rock stars in the future, because there's just a lot of folks that will fall by the wayside. And that wallet share, even though the wallet may not be opened as much as it has been in the past, that wallet share is going to go somewhere. So I think it's going to be some exciting times, but some difficult times as well.
With that last word, it's time for our question and answer segment. I'll say once again to the audience, if you have a question, please submit it on chat, and we'll try to get to it in the time we have allotted. So now let's get to our first question. Duncan, based on your courage and conviction comment a little while ago, I want to ask you about some developments today that have been pointed out to us on the chat. The stock market dropped 500 points this afternoon on the president's announcement that he's withdrawing from stimulus negotiations in advance of the election. Do investors care about that? They seem to care this afternoon, but does it fundamentally impact you as how you think about your investment strategies over the balance of the fourth quarter? You're muted, Duncan, I think. Well, Duncan sort of started his muting. I'm going to ask Steve. There you are, Duncan. Let me jump to you, Steve. Why don't you take that question? I'll come back to Duncan in a second.
Yeah, I mean, overall, does it change our investment philosophy and what we're doing real time based on what happened today? No, to be honest with you, I haven't even really read much of the news past this morning, just being the workday and this session. But it is obviously concerning. We've talked a lot about on the panel the fact that the consumer not only the amount of money they have in their bank account and spending capabilities, but also just consumer confidence is really vital to this economy, especially in shaky times. So, changing what we do and how we're going to act in the longer term or even in the medium term, no. For all we know, something could come out tomorrow. This could be a negotiating tactic. I have no idea. But we do believe that there does need to be some, stimulus taking place. Obviously, the consumer is getting pinched harder and harder, and unfortunately, the have and have not gap is growing wider. So it is concerning from a consumer spending standpoint. But I don't know that one day and one tweet from the president changes our overall outlook. I mean, we've been dealing with this president for 4 years and his tweets and his comments. So we're pretty consistent, staying the course, and we'll see what happens with the stimulus in the near term.
Yeah, any thoughts on that perspective? I mean, do these October surprises that have been coming up affect the way investors are thinking about business and the folks you advise?
Sure. Look, I think the way people invest in uncertain times really hasn't changed a whole lot. You need to have a basic thesis as to what you think is going to happen. If you're a short-term investor, someone that's looking 6 to 12 months down the road, you have to decide what your assumptions are for that time period. If you're a long-term investor, you have to figure out what your assumptions are for 5 to 10 years down the road. Those are economic assumptions, tax assumptions, how we're going to handle the pandemic, and how people's lifestyle are going to change and the impact that'll have. What'll happen in the election is important, but I think I don't think it changes anything in the short term. I think people have a general thesis as to what's likely to happen. I think there's a lot of money to be made if you're right about your thesis. I do think you have to be flexible and agile, because I do think things are going to change or will shift once we know what happens in the election. But other than that, I think, as Steve said, stick to your knitting, make your assumptions, be bold in your thesis, and go find the winners. There's going to be a bunch of winners, and the winners are going to be big winners out there.
So Nick, when you and your team are sort of tearing through financials and analyzing a company and either helping the company or helping investors think about it, how are we dealing with the whole COVID-related add back situation to financial statements? Is your team busily getting people to add 7 sections of additional add backs? Or are you trying to get folks to not pay attention to those? Or how are you trying to think about this? Because in some businesses, you could that have been dramatically affected, the add backs become almost I guess I'll use the word ridiculous, right? I mean, they're just they strain any level of credibility.
Yeah, of course, what I'll say first is when I'm representing a company, there's no such thing as a bad add back. Now, what I would say is that, in all seriousness, when I'm representing a company, you do want the financials, whether they're historical or projections, to have credibility. And I would say, especially if you are trying to help a company raise capital, particularly debt capital, as many of us have said, at some point, this capital needs to be repaid either to investors or creditors. And so I wouldn't want to create a balance sheet for a company based on, quote, add backs that you can't service. You can't service debt, you can't repay debt with add backs. You need cash to do that. So I guess, Jack, that's the way I would answer. That's the way I would answer it, which is that we want the companies and the boards, we want their financials to reflect what we think is a good reflection of profitability, cash flow, and value on a go-forward basis. Because even if a third party, debt or equity party or investor, is willing to provide more capital than maybe the company should have, I wouldn't want that transaction to be based on unrealistic numbers.
So,
I don't think it serves anyone.
so Duncan, when you get that financial statement that has this much EBITDA, and then it's adjusted and it's got this much EBITDA, how are you feeling about that as an investor?
Well, I mean, it's not like I haven't seen it before. And look, in these times, there are some significant add backs on presentations I've seen. Another piece to be careful about is, what was the pre-COVID market multiple? What was sort of the talk about what this business would fetch back then? It's really about, on the businesses that I've been reviewing, it's about what has COVID done to it? What's our expectations of what the new normal? I guess there's sort of like an interim normal now because we're sort of like in this sort of holding pattern right now. I think things have sort of flattened out after rebounding since the spring. But then what's going to take place over the next number of years during our expected investment period, and what will the business look like at exit? And that's sort of standard of what we're doing all the time with every potential investment that we make. But it's really trying to get through to what the mechanism is from where we were to where we are now to where we expect the business to recover to, and then what are the things we can do with the business, investments, add-ons, performance improvement, et cetera, to make the business perform better before we exit the investment.
Steve, when we're looking at our portfolio companies right now, I mean, the fact is a number of them are having challenges with COVID. And for us, at least, it's been a view of sort of saying, let's actually try to take a look at how they were performing immediately before the event, kind of look at what's happening now. Can we kind of trace what's happening now to what's happening for external market reasons, and then look at the plan in 6, 9, 12 months and beyond, and then try to determine whether, with Duncan's kind of courage and conviction, do we believe that they can get back to that? Can they actually? So are we all dealing? Is what we're all dealing with right now with many of these companies, bridges. We actually have to step in and provide capital to make sure they get from point A to point B. And to your point, Nick, those add backs are okay. So Steve, how are you parsing through that?
It's interesting because we talk about add backs a lot, and we're looking at either our portfolio company or new transactions, and Duncan's right. I mean, the level of add backs we're seeing are greater and greater. We look at trends exactly as Duncan said before the pandemic. How are these companies trending before? And again, some of these companies that we're looking at, if it's direct to consumer or if it's home furnishings or something around the home, they've actually fared much better during the pandemic. So it's not just about adding back to EBITDA. It's about where should we deduct from EBITDA? If a company's growing 3, 4, or 5% pre-pandemic, and then during the pandemic they're up 20%, and they say, well, hey, these are changing buying patterns. We're going to need to talk about that and normalize those earnings. On the flip side, we shouldn't say on the flip side, but also with respect to expenses and whether it's our own portfolio company or not. We own a healthcare services business that we have a very variable structure to our company. I mean, it's payroll with doctors and providers and heavy advertising spend. And if you look at the few months that we were pretty dormant, we were able to furlough and not pay a lot of the providers because we didn't have the cash flow coming in, and we cut our advertising almost completely. So when you think about that, we have to normalize. All right, what is the middle of the income statement going to look like, and we normalize those expenses. So when we're thinking about our own portfolio company, we're trying to figure out as we project going forward, how do we get comfort with the top line, but as importantly, where do we think those expenses will shake out? Number one, with all the things that we cut, what can we keep out? And then with what we also cut, what is a must-have, and we're going to have to bake in for a forecast. And that's where we're really looking at it as new deals too. I mean, we see a lot of new deals coming in where they've cut a lot of expenses, and then they don't expect them to return, and that's where we really scratch our head. So, we've got to scrutinize the adjustments both up and down and every which way.
Yeah, and you gotta diligence that. It's A lot of folks will cut expenses and say, look, we really cut costs and it's going to be this way from now until forever. And you got to get behind it and say, okay, what did those people do that you got rid of? And is that still being provided? And is it still necessary, et cetera? So you got to be careful, but that's part of the process.
And
Well,
if they didn't do anything in the first place, why were they there?
Yeah.
It's an interesting question to ask your CEO.
Yeah.
But I think, but Steve, I think you hit on something that's really important. And I think, Duncan, you said something too that I just want to, part of what we often understand is, people have cut enormous expense out, right, over this last 6 or 9 months, in really artificial ways. And I think in ways, Jay, to your point, that you'd say, why were they there? Because they actually are there and they're important to the business, but there was nothing for them to do. So we sent them away for a while, right? Because you're not going to, you try to take care of human capital, but you also have to have a business for them to come back to. And that raises the other question about, okay, when things come back, they're not going to come back, is it going to come back, slowly, or is it going to jump back some businesses, some industries? And do you have the capital on hand to be able to sort of turn those switches back up, right? Move those levers back up? Because I think one of the things we're focused on, I think, is the whole capital smoothing thing, making sure that people have got the reserves necessary to be able to actually invest in order to get the returns we want them to get on the other side of this. So how are you thinking about that, Duncan? Because I think that's a real challenge, because none of us have really good crystal balls as to how long this is going to play out.
Well, there's no across the board way to look at it. Every business is unique. Every situation is unique. Historically, over all of our portfolio companies, we've tended to add to G&A because we sort of found that people minimize their expenses to make the business look better. Unfortunately, what it does is it cuts into the growth of the business. You need to, it's not just CapEx that's investment. You need to invest in your people, and you got to stick that in your G&A expenses, because that's an investment really to develop the business and grow it for the future. So, in the meantime, while we're sort of, getting back to what's going to be the new normal and recover what our economy was in December, it's going to take a while, and through this year and through next year, maybe not until sometime in 22, where we're back to 2019 GDP. So when do you add those folks back? It may take a while before you do it, but you're going to do it. And I look at it as in our investment period that we are going to be doing it probably along the way, because we want the business to grow. We don't want to just maintain and sustain it. We want to grow the business.
Yeah, I think it's an interesting challenge. And you're right, it is industry specific, but, we're looking at financial projections, from our teams where, people are beginning to project the core COVID, I'll call the core COVID period, right, where they would expect, significant disruption, into the third and fourth quarters of next year. I'm not talking about the airline industry, which is saying, revenues aren't going to come back full stream till 23 or 24. I'm talking about just, fundamental businesses that are sort of saying, we don't see, the management teams are just not prepared to say they're going to see the increase, depending on the business you're talking about, in demand until that time. So I think that, we're all trying to figure out exactly where that falls and be, I think, in real people. I'll say to the audience, we have about 3 or 4 or 5 minutes left in Q&A. So if you have other questions, please tap the chat button and let us know, and we'll be happy to ask the panel of that. And then, Jay, let me turn to you. Given your experience for a long time, Jay, you're old. No, just for the over
I am old, Jeff.
3 or 4 credit cycles that have been significant, really over a number of decades. What would be your key takeaways for anyone considering investing in today's turbulent world? When you're giving that advice as vice chairman of Rothschild, what are you telling people that they really ought to focus on? What are your 1 or 2, kind of key sage pieces of advice to people?
Sure, and thanks, Jack. And I think it's all the things we've been talking about. It's first, what are your assumptions? Are you a short-term investor? Or are you a long-term investor? What are your assumptions about what's going to happen in the election? What are going to be the takeaways from that? Tax policy, economic policy, and how people live their life, and what the impact will be on industry. So that's one. What are your assumptions and your thesis? Step 2, I would say to any fund that's looking to invest, be bold, but which they usually are, but don't be reckless, which they never are. You never want to be in a position where if you're any of your key assumptions are incorrect or change, that the fund gets killed. So that's sort of point two. But point three is something we've all seen over a long period of time. Be flexible and agile. Whatever your assumptions and thesis are today, we all know the facts are going to change tomorrow or 6 months from now or a year from now. And the companies and the funds that do well are the ones that are able to adapt and change to changing conditions very quickly. So those are my key takeaways from doing this for the last 37 plus years.
Nick, your thoughts? I mean, there are press releases in the market today that some of the folks in your space are expanding and consolidating their businesses to prepare for to handle all the coronavirus work that's coming in. When you sit and talk with companies and you have that opportunity to sort of say, these are the couple things you ought to think about, and from your perspective, I'll ask you, how do you try to? What do you say to companies in terms of trying to attract the right kind of investor in these situations? Is everybody's money, is everybody's currency as good as anybody else's, or do you try to look for particular kinds of investors into your businesses?
I guess what I would say is, given the uncertainty that we've been talking about on this panel for the last hour and a half, and frankly, all professional investors and professional advisors have been talking about since March or even earlier, no one knows where this is going. No one knows, even post-vaccine, how it's going to impact consumer behavior on a go-forward basis, and I think it's going to. The advice I would give to companies is cost of capital is obviously important, and investors understand that the cost of capital is competitive. But I would put a lot of emphasis, when I'm advising a company, on the patience of that capital. Again, there's going to be volatility. You commented, Jay, on just in the last couple hours how volatile the equity markets have been as a result of some of the comments that the president made. Markets are always going to be volatile. I think the economy is going to be volatile, and so patient capital is better in situations like this. So,
Steve and Duncan, maybe I'll go back to you, Duncan, first, and now Steve for the follow-up here. As investors, one of the things that one of the banes of our existence, right, are event risks that we cannot currently anticipate. What's the next thing? What is the next thing that's going to happen, right, on top of this, right? And we often we spend time, I think, in investment committees and sort of looking at those challenges and trying to anticipate even things that can't be anticipated. As you're sort of looking through the end of 2020 and into 2021, not to try to be a downer here, but what's the kind of the worst thing that you're on the outlook for? You're trying to figure out is this going to happen, and what does that mean to to our investment strategy?
Well, I think the thing that we worry about and we discuss, it's hard. Look, it's event risk. It's hard to say what's out there that we're worried about. The thing that happened earlier this year with the shutdown really was tough on our businesses, and a lot of liquidity got sort of flushed because of that in a lot of different businesses, and so doing that again would be very painful. So we talk about, okay, do we need to make sure that if that occurs again, that we're well prepared? I don't think we think it's going to happen again. I think our human nature is that we want to get out and do things, and you can see it in this sort of second wave that we had during the summer, which is much larger than the wave we had in the spring. That life went on, but that's kind of what we're thinking about. But other things like war, other pestilence, other stuff like that, boy, it's really hard to predict that, Jack.
No, right, I hear you, Steve.
Yeah, I tend to agree with Duncan. I mean, it's obviously really difficult to predict what's going to happen. I mean, the things that we worry about are a lot of what we talked about on the panel today, which was consumer confidence, consumer spending. I mean, that drives the economy. And if the economy still gets battered and companies are hurting because of it, and taxes are going up and cash flow falling, we just need to be prepared, and we need to have our portfolio companies be prepared. and really analyze their fixed and variable cost structures so they can flex up and down. As importantly, making sure we have, liquidity to get through, a storm like we just went through, and that happens and is achieved by, great management teams and thought leaders, and being on top of the numbers and reacting quickly. And and we always talk about it on capital, and patience is a virtue. Know the numbers and think differently. And in turbulent times where it's up and down. I mean, you asked earlier today about the stimulus and that being punted. I mean, we got to act fast, and we got to think differently and react to what's coming. And that's the difficult thing, is none of us know, but at least I think we all would agree, and we all know that it's not going to be smooth sailing, and it's not going to be linear on the way up. It's going to be very choppy with some peaks and valleys, and we're all going to be prepared for it.
Well, Steve, once again, that's going to be the last word, because we were at our ending point. I want to thank everyone for their participation. I want to thank the audience for the questions. Our apologies to those we weren't able to get to this afternoon. Thanks again for joining us. We look forward to seeing you at the next virtual session by the M&A Advisor. Thanks very much.
Thanks, guys.
Thanks, everybody.
Stay safe.
Thank you.